Hey guys, Jesse Malek from Indi Mortgages. I just wanted to go over what it takes to qualify for a mortgage and what we're actually looking at to determine those numbers. So there's basically three things that are going to go into qualifying for a mortgage. One is your income, second is your credit, and third is your existing debt. So obviously with income, that's pretty straightforward. We look at how much you make and determine whether or not you can afford the payments. Now, in terms of income, what the lenders are looking for is to make sure that you're at the same employer, usually for 2 years, or in the same industry for 3 years. So just because you switch jobs doesn't necessarily mean that you can't qualify for the mortgage or we can't use that income, but they do want to see that it is in the same industry or at least something very similar. Now, in terms of credit, just because you have bad credit doesn't necessarily mean that you can't buy something. But the better your credit, the less expensive it's going to be. So if you have anything that's like a collection or a sub 600 credit score, for whatever reason, maybe it's missed payments, too high of a utilization, you're going to fall into what's called alternative lending, which is going to need at least 20% down. And then your interest rate is going to be a little bit higher because they do penalize you for that added risk that the lender is taking on. The next is your total debt situation. So there's two calculations that we use called your GDS, which is your gross debt service ratio, and your TDS, which is your total debt service ratio. So your gross debt service ratio just takes into account the property costs. So that's your property or your property taxes, mortgage payment and interest, heating. So that is usually the number that doesn't hang people up for the qualifying. What does become an issue is the total debt service ratio, where when we do look at that number, we include all of your existing debt, including like your car payments, credit cards, student loans, stuff like that. So that can add up pretty quickly. Those two numbers for GDS, if it is an insured deal, the GDS has to be 39% or lower. If it's for the TDS, it has to be 44 or lower. If it is an uninsured deal, on the A side, we can go up to 44, both TDS and GDS. If we are going alternative, then there are some other options where we can go up to 55, depending on the loan to value, meaning how much are you borrowing versus the value of the home. So it's usually the total debt that causes people to not be able to qualify, or it's their credit score and they just simply don't have the down payment. So what can you do to better your chances of qualifying? Well, first, you're going to want to make sure that you are making as much money as possible. Homes are very expensive right now, right? So just the payments on a mortgage, they can eat up a big chunk of your change. So maximizing your income, even buying it with, like, obviously if you have a spouse, you're going to buy it together. Maybe asking a parent to co-sign on the mortgage for you might help a little bit. If you do have any credit issues, like your credit score is under 600, I would recommend trying to figure out what is actually causing that to be lower. Is it because you're missing payments? Is it because that the utilization is a little bit too high? Or is it just that you have a collection on there that needs to get paid off? So figure out what those issues are, address them. If you don't know, feel free to reach out. I don't mind taking a look at your credit report and seeing what the issue is and giving you some advice on how to fix that. The other thing that you're going to want to focus on is maximizing your down payment. Obviously, the more money that you have to be able to put down, the better. And then the most important thing, if you do have additional debt, is try and get that paid off as quickly as possible. Now, I know it's not always easy. Like, for example, with a car loan, you might owe $30,000 on it and your payment's $500 a month. Even if you pay that down, the payment's not going to change, so it might not be the wisest to attack that debt. But if you've got credit cards or small personal loans, or you only owe, say, a few $1,000s on that car still, it might make more sense to use some of that down payment money to pay off that debt going forward. So that's basically what it comes down to, is those three things. It's income, your credit score, and your debt. Obviously, your down payment does play a factor into it, but we're assuming that you already do have a down payment. So it's those three things that are the reasons why you may or may not be able to qualify. So if you have any questions, obviously feel free to reach out. My contact information will be down in the description. Have a great day.